Good morning, everyone. I would like to welcome all participants of this call this time to EPP's Interim Results 2020. Given what we are all aware of, the dramatic impact of COVID, unfortunately we couldn't come in person to see you as always in the past. We hope that the digital equipment that we're using will work well for everyone. So, warm welcome to everyone. I would like to say that clearly it has been a very difficult year across the globe. It hasn't been different to EPP. What we would like to do today is to guide you through what has happened so far in 2020, provide you the update on the business of EPP, especially in related to COVID and its impact, and also go through operational review, financial review, and then finalize with some strategic commentary, outlook, and guidance. I will do the session with my colleagues, Michał Świerczyński and Jacek Bagiński. Let's then move on to more details. So I'm absolutely sure you all are monitoring the developments in the world related to COVID, what is happening to economies across the world, what is happening to retail trading, what is happening to retail landlords. Poland clearly, and we'll show you some details, has been impacted, but going forward is expected to be one of the least impacted economies in Europe. Importantly, it has one of the lowest COVID-19 infection rates. It is existing, people are getting infected, but in comparison to a number of other European countries, it's actually one of the best countries in Europe in that regard. However, what has happened mid-March, when we rushed back from Johannesburg to Warsaw shortly before closing of the borders, Polish government has decided to release the tenants from paying the rents, and landlords haven't been compensated for it. This is probably the most important reason why you have seen the results probably this morning. Clearly, our 2020 results have been very significantly impacted by that because there was no compensation whatsoever that was offered to landlords. On some key operational indicators, we are very pleased to say that nearly 100% of our portfolio is now operational. Occupancy is stable at around 96%, and Michał, my colleague, will provide you some further details on this. Very importantly, in September 2019, we have reached an average level of 85% of footfall levels on a like-for-like basis in comparison to September 2020. Both this footfall and tenant turnover are constantly increasing, and that's something we're very happy about. By now, Michał and his team has been extremely busy with negotiating tenant conditions. We have provided discounts to tenants in 2020, however, in return for material extension of the leases. So we did what we believed was essential to tenants after the lockdown finished, but in return for what we strongly believe is heavily increasing resilience of EPP business going forward, especially with significant extension of the leases, and in many cases also increases of the rental levels after the discounts terminate. One other comment I would like to make is that post-COVID, we have seen some new shop openings in our portfolio, and Michał will give you some details on it. Why I'm mentioning this in the highlights slide is that we do strongly believe physical retail, and especially EPP dominant portfolio in Poland, will continue to be very attractive place of shopping and will continue to be attractive place for tenants. These new openings are a great evidence of this, with tenants moving in after COVID. Finally, on key financial indications, We are very stable with liquidity position of 177 million euro. And my colleague Jacek Bagiński will provide some further commentary on it. Everyone is clearly watching and being afraid or nervous with the valuations. We have completed our mid-year valuations, which is clearly 2 to 3 months after COVID. And we're very happy to confirm that our value has decreased by less than 4%. Therefore, our current LTV is less than 52%. It has increased from 50, but it's still very well within the covenant levels. Our average covenant level is 68%. So we have a very significant headroom in terms of where our LTV is in comparison to the covenant levels that we have in our debt agreements. Finally, you probably have seen this in our release that we communicated on Friday afternoon. We are very happy to confirm that our guidance is increasing from the levels that we provided back in June to the level of 4.75 euro cents to 5.25 euro cents for the full year 2020. And this is possible because we are achieving faster and better increase of footfall and turnovers and completing the renegotiations with tenants on a faster pace as well. Moving on, I have mentioned already that Poland has one of the lowest cases of COVID. In nominal numbers, this is 77,000, but more importantly, I would like to show you the statistic that is used across the world now, especially in terms of defining travel restrictions by the governments. This is a 14-day cumulative number of COVID-19 cases per 100,000 of inhabitants. What it means is that it gives you the scale and relevance for each particular country. We have used the numbers from a few days ago. Poland has increased since then, but most of other countries are increasing as well because autumn is coming to Europe. The point I'm trying to make here is that Poland is clearly one of the lowest impacted countries in Europe, with the rate as per 18th of September of only 20. You will see on the slide, I hope you can see it clearly, that this is one of the lowest, if not the lowest, number out of the big countries in Europe. Why does it matter? Well, it matters because it motivates the economy to come back to pre-COVID shapes in an efficient way. The slide you currently see, I don't want to go into detail. We have showed you the same slide back in June. I would, however, like to make one specific comment. Poland has opened the malls as one of the first countries in Europe. Germany was earlier, but some other countries, you can see the example of Romania or Spain, much later. And that's good because it allowed recovery on a faster and more efficient way. However, the very important aspect of the lockdown that took place for 7 weeks is that we couldn't charge the rents to 80% of tenants in our portfolio, and we got no compensation for it. And I already mentioned that this has impacted our results quite significantly this year. I'm mentioning this here again because this lockdown has happened when none of the governments in Europe really knew how strict, how severe, how bad COVID will be and what needs to be done in this respect. Today, various officials of the Polish government, including the Prime Minister, have stated very clearly that they know how to deal with COVID and that they will not go into second lockdown. Of course, we all need to be aware, and we are fully aware at EPP, that the rates of infections will be growing over the autumn season, which is typically a higher flu infection season. However, there has been work done in the hospitals, and the government is very, very motivated not to do any lockdowns going on. So we do believe this may have an impact on the footfalls, but shopping centers will continue to be open, and we can gradually improve on the operations. So I mentioned about this efficient early opening, but also quite drastic measures that the Polish government took in March and April result in Polish economy reverting to good shape faster in relation to most other countries. The slide you currently see in front of you is the mobility trends. That's based on Google and the laptops, mobile phones, tablets that people are using. This number, importantly, is comparing the lockdown period to the period from May to almost the end of August. Already within this period, Poland almost returned to pre-COVID mobility levels. This is the latest data we could grab. If we had the data by today, by almost the end of September, the mobility in Poland would be, I'm pretty sure, at pre-COVID levels. And you can see it on the streets. You can see it in the shopping centers. The traffic jams in Warsaw are back. People are reverting to the offices. Not all of them, and it will take time. But you really can see that economy is reverting as quickly as it can. In terms of the economic stimulus provided by the government, we have provided this information back in June. Not much has happened since then, except one important thing, which is on the right-hand side of this slide in the light gray color. This is the EU decisions on both the EU Recovery Fund, that is COVID-related, and which amounts to euro 750 billion, and also importantly, the next seven-year EU budget, which has been approved at the amount of 1.1 trillion euros. Poland, because of its size, is expected to be a very material beneficiary of both of these programs. And again, why it's important? It's important because it will be used across the economy. It will be used to support the companies. It will also be heavily used to provide infrastructural works, which in turn should generate increased spending power that we hope to see happening in our shopping centers. Very quickly, just so as you understand the context and the impact of the COVID on EPP business. Before the lockdown, when we came over mid-March to meet you in person, we had a fantastic case evolving for EPP business from the beginning of 2020. Just to mention a few statistics. Sales just in January and February 2020 were up by 4.3%. Footfall in the same 2 months has increased by more than 2%. Our collection rates were almost 100%. OCR and rent-to-sales ratios, you can see the numbers, 13.8 and 10.2% respectively, which are really good and strong numbers in comparison to the market. Importantly, in South Africa, I understand that when you calculate the OCR and RTS ratios, you're using hypermarkets and supermarkets. In Poland, hypermarkets, supermarkets don't provide the turnover numbers, so these ratios exclude them. What it means that if we included them in our numbers, the two ratios would be well into the single-digit numbers. Final comment on this slide is our occupancy was around 96%, so similar to what we have now. So we're really maintaining the same occupancy levels, and Michał will explain the 4%. This only results from some temporary reshuffling of some tenants. What happened during the lockdown, I'm sure you know, but in Poland, almost 80% of our shops in our portfolio were forced to be closed, and we clearly didn't charge any rents. We couldn't charge any rents, nor service charges. We had a strong immediate focus on liquidity and cost optimization. Jacek will provide you with some more detail on both of that. I believe we have done what we could very efficiently. We have also decided to spend quite a lot of effort and time on supporting the communities within our respective shopping centers, just to build further relationship with our customers. We also paid a lot of attention to safety of our staff and customers in the shopping centers. We have spent quite a lot of time also talking to the government, who was thinking at some stage of extending this no rents for a few weeks after the lockdown was finished, and we got into some good conversations, and the government decided not to do that anymore. And last but not least, even though the commercial real estate in Poland didn't receive much of the governmental support, there was some labor cost support that we used. Post-lockdown, this was a quick decision announced by the government only a few days before the date. We immediately, there was a lot of work, as you can imagine, focused on safety of staff, and more importantly, customers. We really wanted them to come back to the shopping centers as quickly as possible. And over time, per governmental decisions, we're increasing the GLA operational. We spend a lot of time with tenants, trying to understand their position, but also negotiate the terms that would be acceptable and allowing tenants to survive, but also create some value for EPP. I have already mentioned at the beginning that our strategy from the beginning was to provide tenants with support in 2020, partially maybe few weeks, few months of 2021 as well, but in return for very material extension of the lease agreements, as I already mentioned. What we are seeing since is gradual footfall and sales recovery since reopening. We'll show you some statistics. I also have already mentioned that new tenants or existing tenants but opening new shops, this is also something we're seeing in the portfolio, and we're very happy to see it. On the macro levels, I have already mentioned that Poland is looking resilient in comparison, but few important facts that I wanted to share with you. Why we do believe EPP is having its operations in the market that has really strong fundamentals, clearly impacted by COVID, but able, because of these fundamentals, to recover, we believe, faster and more efficient than in a lot of other countries. So what you see on the screen is the compound GDP growth forecast done by Oxford Economics for the entire Europe for 2020, which is clearly a reduction, and 2021, which is between 3 and 4% growth. So those 2 years combined, as forecast, per recent forecast of Oxford Economics, Poland should be above 1% of GDP growth. So we are on the path to revert. And I commented on mobility, I commented on governmental decisions. We believe this is very likely to be happening. You see some other economies, you see this 2-year combined growth plans for some countries are negative. Poland is well into the positive, and it's independently assessed by Oxford Economics. Few other important fundamental facts, i.e. facts why we believe EPP business, after these quite dramatic events in March, April, and clearly to a big extent throughout the rest of the year. We're not through that, and we're clearly dealing with COVID as we speak. But few fundamental things that I believe are very important for EPP. What you see on the slide, the blue columns, this is the forecast salary increases in Poland. So there's an increase that is happening also in 2020. That's driven by the growth of the economy that I just highlighted, but it's also driven by the low unemployment rate. This is the orange line that you can see on the slide. There is an increase in 2020, as you can see it. The forecast is that it's going to revert back to almost record low level in 2021. It means continuous push on the salaries, and that's why the forecasts are as you can see them. It also means that Poland will continue to need employees from outside. There's a lot of people from Ukraine, for instance. This trend will continue. What does it mean for the business like EPP? It means that the spending power will be increasing for the population that is based in Poland, but also for these people that will come to work in the economy that has a very low unemployment rate. One other comment I would like to share with you, and I'll comment in the strategic part of this presentation in a bit more detail, but Poland has continued to be liquid market in terms of real estate turnover in 2020. The numbers you can see on the slide are for first 6 months of the year. There have been further transactions since then, in July, August, but you can clearly see that there were almost 3 billion euro of transactions completed in Polish investment market, Polish commercial real estate market in first half of 2020. 0.4 billion, so 400 million euro of that was retail. So retail does also trade. Of course, the current emphasis is on logistics, partially on offices, but retail does continue to trade. We have seen deals in retail parks area more than in the dominant shopping centers, but we strongly believe the appetite and the general confidence of investors, global real estate investors in the Polish market continues. One other fundamental thing I really wanted to highlight, again, we have mentioned it in the past, but again, given the COVID impact, and I would like to just build up the case and try to share this with you on why we believe the recovery should be stable and fast for our business. Poland has a ratio of 265 square meters per 1,000 inhabitants. It's almost in par with Western Europe, slightly less. Western Europe, you can see on the slide, has 282 square meters per 1,000 inhabitants. However, there's two very important factors here. These numbers don't include high street. Some of the countries in Western Europe have huge amount of high street in addition to shopping centers. So when you add it in some countries, this statistic would double to those countries. Poland hardly has any high street. So really these numbers, the gap between the supply of space per capita in Poland is very, very material. Secondly, because of COVID, but also in the past because of general saturation of the market, we do expect that there's going to be very little product, retail product, shopping center stock built in Poland in the years to come. So really the existing stock should continue. And again, in terms of safety on investment, I'm sure you understand why this is a very, very powerful information going forward in terms of resilience of the portfolio. Final comment that I would like to share with you, which I'm sure is also of great interest. A lot is being said about e-commerce and online sales. What you can see is the statistics for Poland as measured by the main statistical governmental office of Poland. You can clearly see that in March and April, the online sales share in total retail sales in Poland has increased to a peak of almost 12%. But please have a look what was happening since then. In May, it was already down to 9%. By now, in August, it's very, very close to pre-COVID levels that were recorded in January and February. Again, what does it mean? It means, and I don't want to argue with it, I don't argue with it, the online sales will be increasing over time. But people, and maybe especially in Poland, really prefer and like physical touch of goods. They like to check what they are buying. And these numbers are proving this, in my opinion, very, very strongly. Again, the trend will be for online sales to be increasing, but I strongly believe with the defined competitive amount of stock per capita and clearly the trend, the preferences of the Polish customers, we believe the real future is omni-channel with a very significant role and space for physical retail. To finalize, before I hand over to my colleague, I just focus on the fundamentals and will give you some more specific details about EPP portfolio in a second. The key points I wanted to share with you are as follows. Polish government decided to do some very quick and quite significant moves. However, as illustrated by the number of COVID infections in Poland, it really seems to be working well, or at least better for Poland than a lot of other countries, which is fantastic news in terms of the prospect of recovery. Economic activity, especially as illustrated by the mobility trends, is quickly reverting. And finally, the GDP numbers that I have presented, as assessed by independent economic research houses, are really showing a very positive picture for Poland. EPP, clearly having all of their assets in Poland, is really expecting and planning a smooth way to return to pre-COVID levels of operations. Michał, over to you.
Thank you, Tomek. Good morning, everybody. We'll start our operational review with a reminder. EPP owns 25 dominant shopping centers located across Poland in the affluent retail markets, serving annually 120 million customers with a great offer comprising of international and national market leaders located on more than 900,000 square meters of GLA. As mentioned before, the impact of COVID has led us to take strict sanitary measures in our shopping centers with the main aim to provide a safe environment both for the clients and the staff. And that includes location of disinfection materials in all the important public and common spaces in the shopping center, regular communication to the customer and staff on safety measures and precautions, regular and frequent and even more frequent cleaning and disinfection actions in the shopping centers. EPP has always been very active within the local communities, and during the COVID times we have immediately responded with all the help and support that we could, mainly to the local hospitals. Everyone in our team felt this is the right thing to do. We have donated 17,000 masks, other sanitary equipment, free meals to the medical staff, but also a lot of support to the senior citizen during the lockdown period. Now, before I get into this slide, I would like to repeat what Tomek said before, because I think it's very important. The reaction of the Polish government and all the related governmental institutions to the pandemic was very adequate and prompt. This has allowed to control and minimize the spread of the virus in Poland. And Poland, luckily, has not experienced such a tragic wave of the virus like in Italy, France, or Spain. The number of infected people, and sadly, of course, some of the death cases, was proportionally, and I would say significantly lower than in the other countries. This has also allowed to finish the lockdown quicker than in the other countries. This has also allowed a quicker start and getting back to our normal lives than in the other countries. The consumer optimism remain high. As you can see from those numbers, every month and every week, we've seen a growth in a footfall, finishing up in September with 85% of the level pre-COVID. This is higher numbers than we expected. And looking at the development of the shopping habits in our shopping centers, we believe that number will be growing. From a turnover perspective, the numbers are also showing a growing trend and a quicker rebound than we expected. You see, of course, a very positive number in July, 93% of the level of 2019. But one has to mention that this is strongly connected with massive sellouts of the tenants across all the shopping centers and across all Poland, where tenants were liquidating very quickly their spring and summer stock, trying to catch up with the lost time during the lockdown. The sellouts, of course, had a huge and negative impact on the margin levels and the profitability of the tenants. Therefore, it's crucial now to observe the autumn and winter season, upcoming season, where the tenants will also be facing challenges, as many of the tenants has informed us that they have ordered less of the stock. So we'll be carefully monitoring that trend. Yet then, as mentioned, both the turnover and footfall higher than expected, and from each month we see a growth and more confidence of the clients returning back to our shopping center. Now, as Tomek mentioned, and it was mentioned previously before, our relationship with the tenants were designed in a way that we've managed to open up our shopping centers with all of our tenants. It was important to provide the same atmosphere and the same offer as pre-COVID. We have also managed to build the relationship with the tenants in a way that we managed to open all the contracted stores. And here on the slide, you can see some of the brand names like Primark, which has already opened, Carrefour, which is opening actually tomorrow, in 6,000 square meter in Olympia, and other brands across all the sectors. Let me start. Here you can see, of course, some of the pictures of both fashion and even the F&B tenants that has opened across our portfolio. Pepco, a brand new CCC big store in Włocławek, juwelier stores, even the local ice cream stores, LPP, and of course the Primark. Primark is one of the most expected market entry in Poland. Primark is one of the most successful department stores in Europe. I'm very excited to have their first store opening in Młociny in our Warsaw asset. And with 5,400 square meter, this will be, and again, the first store in the Warsaw market, which is already generating in the first week of opening additional footfall of 200,000 visitors. So definitely looking forward, as Primark will give a great boost to our Warsaw asset. And I would like to invite you now for a 1-minute short movie from the opening of Primark in Młociny. But Primark is not all the great news coming from Młociny. As you can see here on the slide, the two other very important openings in Młociny is Modivo and eObuwie. These are one of the most modern omni-channel stores, not only in Poland, but also in Europe. Both stores have started their business online, but the physical presence allowed them to interact with the customers. You can pick up your online goods as well as do your offline shopping in Młociny. The advanced technology allows within seconds to deliver very wide offer of shoes and fashion garment, which is located in the back part of the store in a huge warehouse, giving for the customers a true unique experience. Now, as the key takeaways from my presentation, and of course, I'll be happy to answer your questions later on. And again, we went through the lockdown successfully in that sense that we've been able to reopen with all of our tenants after the opening. And again, this is very important to start our reclaiming back the footfall and the turnovers. Our WALT is currently at 4.7 compared to 4.2 pre-COVID. And we will see that number grow as we are now finalizing our rebate annexes connected with significant prolongation of the leases. The footfall and turnover numbers both above our expectations, and I think giving in last 4 months, these are numbers which give a very optimistic view to a quick rebound and return to the normal business, hopefully by beginning of next year. Thank you very much. I'll be happy to answer your question later on. Tomek, over to you.
Jacek. I would like to welcome.
Good morning, ladies and gentlemen. I would like to present you the financial results for the first half of 2020. Let me start from the summary of profit and loss accounts. You can see on this slide the comparison of our results for the first half of the year to the first half of 2019. Starting from the top line, you can see that our net operating income for our own properties, but also for JV properties, was negatively impacted mainly as the result of the lockdown that was enforced through the introduction of the decree by the government. That lockdown period lasted 1 month and a half. And also that deterioration or drop of the net operating income was or resulted from the concessions that we granted to tenants after the stores were opened. In that period of the lockdown and after the opening of the stores, we worked on the reduction of our property expenses and administrative costs. So, and we managed to achieve significant savings, both on the property costs, and these savings account to over 5 million euros. And also, we have some savings also on the administrative costs as the result of the reduction of the payroll that accounts to 400,000 euros. In regards to our interest expense, although the interest costs remain at the stable level of 2.5%, you can see here the increase of the expense by 1.8 million euros, which is almost 11%, and is driven by the fact that we intentionally decided to draw all our available credit facilities during the lockdown period in order to secure liquidity in the company during this difficult pandemic period. On the current taxation, you can see the saving of 2.9 million euros, and that is driven by the fact that the government granted real estate industry with the relief on the or the exemption of the payment of the tax calculated on gross asset value of our assets. At the bottom line, you see that unfortunately that lockdown period and the period after the lockdown, when we granted concessions in regard to the rental income, resulted in the significant drop of the distributable earnings from 5.8 to 0.38. But as Tomek said at the beginning of the presentation, since we see a faster recovery of our business comparing to the times when we were under the lockdown, we were pleased to announce an increase of our guidance for entire year from 4 to 5 euro cents per share to from 4.75 to 5.25 euro cents per share. In regard to the balance sheet, we completed valuation of our assets that ended end of June this year. This valuation was done by the independent valuators of Savills. And you can see here we took a hit of 3.9% of the value decrease comparing to the end of 2019, and this consists of two elements. One element is the purely cash flow element related to the discounts that we granted to tenants, mainly until the end of 2020. These discounts should be eaten up by the end of this year, so we should not see that cash flow impact continuing in 2021. And the second element is the market element that is obviously beyond our control and consists with both the widening of the yields and the increase of the discount rate. So all in total, if you see and look at the very bottom, our annualized yield of the portfolio after the devaluation is set at the level of 6.8%. What you can see also on the balance sheet is that, as we already spoken about it, we built a significant cash buffer. So cash balance increased by 110 million euros comparing to the to the end of 2019. And this, as I said, we did intentionally in order to make sure that the company has enough cash to operate during the continuous pandemic period. Obviously, that increase of the cash came from, as I said, mainly through the drawing of the available cash and credit facilities, but also as the result of the retention of the dividend for the second half of 2019 and the first half of 2020. NAV per share declined from 1.32 to 1.21, mainly due to the devaluation of our assets, driven, as I said, mainly by the market impact, accounted to 3% of the value of our assets. In regard to liquidity, as I was saying this already a couple of times, liquidity is the most important, or was the most important for us during this pandemic and the lockdown period. So we secured a significant amount of cash on hand to run the company safely. Obviously, this came with the increase of LTV that was, in addition, increased by the devaluation of property assets. So you can see that our LTV went up from 50% to 51.7% at the end of June 2020. Looking at the maturity of our debts, you can see here on that slide that we will have a significant refinancing event in 2022 and 2023. This, however, these amounts that you can see on that slide in 2022 consist of 11 different loans provided by the Polish and international banks, and in 2023 these are 12 different loans also provided by the same banks. So although the amounts are significant, they are spread between different assets and different banks. What also happened during the lockdown period, we saw a strong support from our banks that engaged with the discussions with us, mainly on the suspension of amortization, and we, in most cases, managed to agree the relief from the amortization of these credit facilities until the end of 2020. So this was really, we highly appreciated the support and cooperation of banking industry in Poland and in Europe, helping us to manage our liquidity through these difficult times. Therefore, I can say that we are pretty confident on our ability to refinance our debts in 2022, in 2023. In regard to the financial covenants, we have a significant headroom both in case of LTV, which is set right now at the level of 51.7%, and comparing to the average level agreed with the banks, which is set at the level of 68%. And similarly, in case of debt service cover ratio, our ratio for the period ending 30th of June 2020 was at the level of 2, comparing to the average covenant agreed with the banks, which is 1.4. Thank you very much.
It was an important one, clearly. Very briefly now, you are all aware about the tranche 3 that has been signed up already a number of years ago. Just a brief update. We haven't yet closed on this acquisition, as you are very aware. We have signed an extension agreement with Chariot, and we're negotiating the transaction terms, improved transaction terms. We are willing to close the transaction. We hope we should be able to do that by the end of 2020. Just one point of commentary here. Retail parks have managed, on average, better than shopping centers throughout the COVID pandemic. And actually, the photograph that you can see on this specific slide is not pre-COVID. It's actually from this year, from around June. I was there actually myself as well at the end of June. And this is one of the power parks in Olsztyn, I believe. And it's really this kind of car traffic that you can see there these days in front. So they continue to trade very well. And second to that, I mentioned earlier today about the transactional activity. The 400 million euro traded in Poland was mostly in this sector. Retail parks continue to appeal to investors, continue to trade very well. So finally, a couple of comments before we move on to the Q&A session. Jacek was talking about our current loan to value. We have very significant headroom in our loan to value, and moreover, we believe that we will be in a position to refinance in the meaning of agree extension of the loans or agree new loans with the same lenders on most of our properties. These are long-term lenders committed to the Polish market, and we do have very solid situation in terms of headrooms and in terms of operations, especially now when we're expecting to come out of the COVID-related discounts that we provided to the tenants. However, we are very clear that our LTV is higher than some of our peers, and it is our commitment of the management to reduce this loan to value over time. This is not driven by the fact that the banks will require that. We actually believe that the banks could accept even a higher LTV, and actually you could see that IPO LTV for EPP was much higher and financed by the banks, and we know non-listed companies are typically having much higher LTVs in their properties. So this is not driven by the lenders. I want to make it very clear. The lenders are not pushing us. We were able to draw on our corporate loan earlier this year as well. The lenders are confident in EPP business. This strategy is because we want to lower the LTV in the context of perceived resilience of the business. In order to do so, we believe the most efficient way is to identify few assets that we own and dispose them. We will be doing this exercise over the next 18 months, and the final decisions will depend on our assessment of the liquidity, interest, and the pricing. I want to make it very clear that we don't have to sell, and we will only sell if the interest from the market is at good levels. Our preferred strategy would be to continue as a joint venture partner and continue to asset manage. But we will make the decisions on this dependent on the interest. But again, very clearly, this is something we believe is good for the business. We would like to do that, but this is not driven by the senior banks. It's driven by our strategic goal to materially reduce our loan to value going forward. An important final comment on this that you see at the slide is that we are very committed to revert to paying dividends as soon as possible. This clearly means 2021. We believe it is possible. One thing that I probably should comment on that is that the discounts that you have seen impacting us very, very materially in 2020, plus of course the lockdown period where we couldn't charge rents, only some of them continue into a few early months of 2021. Upon the termination of the discounts, we are reverting to pre-COVID rental levels. And in many cases, actually, we're increasing them to compensate for the discounts. And we have significantly longer weighted average lease term on our leases. So as soon as these discounts are eaten up, and this will be happening over the next few months, we will come back to a resilient business case as strong as it was before COVID, or I would even argue stronger, because this would be on extended leases, and this would be with tenants that agreed to extend their leases within our portfolio, within our respective properties. They could only do that if they believed in their long-term interest to strategically be in our properties. So my point at the end of this presentation is that this whole exercise clearly resulted in our revenues in 2020 to be very materially impacted. But the long-term fundamentals, long-term business case for EPP, I would argue to be even stronger than it was before COVID. On the outlook for 2020, I have mentioned at the beginning, Jacek has mentioned that we are expecting an increased guidance and increased result, as we have commented. However, what will be our focus? Clearly, we still have some leases that are in the final stages of renegotiating. We know where we are. It still requires some time to go through the legal work, but we will finalize on all of that within the next maximum of few weeks. The entire team at EPP is focused now on maximizing footfall and tenant turnover in the centers. This does relate to safety, but it also does relate to various marketing activities that we are reverting. We have stopped quite some of that in immediate response to COVID and cost saving, but now we are on the way to really revert back to marketing our centers. We have big plans for 2021. Last but not least, I have mentioned about the balance sheet. We are very committed. We'll do every necessary preparation step by the end of this year to fully analyze our portfolio, to analyze our assets carefully, and to prepare the program of recycling certain assets that we want to undertake within the next 18 months. This guides me to the last two slides. This is the guidance we provided to the market back in June. And as Jacek has said, as I have stated, we are happy to see EPP on the right direction, and that's why our updated guidance that we're very comfortable with in terms of the entire 2020. Maybe a few final comments I would add before we move to Q&A. I'm sure you are monitoring our share price on probably daily basis. I can only assure you we do exactly the same. What I'm seeing, especially in the recent 10 or so days, was a further drop. I hope you noted the fundamental comments about the fundamentals of the market that I have made. We currently have an NAV that was revalued in June of around 1.1 billion euro. Our market cap is around 220 million euro today. It's 20% of NAV that has already been reduced by the COVID impact. Moreover, Jacek has mentioned we have the cash position in the company of 170 million. This is only 50 million less than the total market cap of EPP. We will be eating up the discounts that we provided to tenants in the next couple of months. 2021 is going to be very materially better year. We will continue based on these strong fundamentals, the business case, but also the quality management teams within EPP on a very clear path to recovery, and we will revert to paying dividends in 2021. So I can, as my final word, only recommend that you revisit our numbers, you revisit our business case, and rush up to be buying EPP shares and pushing the price up. Thank you very much. Before I move to Q&A, and we have received 3 questions, I would like to apologize because I'm being told that at the very beginning of our presentation there was some technical issue. We didn't see it here. I hope it was only at the very beginning. I would like to apologize for it, but I hope you managed to well receive most of our presentation. So we have 3 questions. Let us go through all of them. The first one is from Anas Madi, and it deals with the very little detail is provided on performance of different shopping centers. We have decided to be kind of focused on the bigger picture fundamentals, but of course we can answer this question. Michał, could you maybe briefly provide some color on on our shopping centers specifically.
So the numbers related to the turnovers and footfall now 4 or 5 months after rising up the lockdown is quite equal. We have seen, of course, a bigger growth in Młociny because of opening both of Primark, Modivo, and other tenants, and that positively boosts the turnovers and sales in the centers. Maybe what will be interesting for you is, of course, and of course we said it in our June presentation, back in May and June, we have seen that the shopping centers, smaller format or in smaller cities, have had a higher footfall figure to comparison to the big inner city projects such as Pasaż Grunwaldzki, Galaxy, which was an Echo in Kielce, which was strongly dependent on the urban vibe, which was missing, on the students, on the office workers, and on the whole urban traffic and the whole vibe that simply was still under a post-lockdown situation. This has changed once the people start returning back to their offices. We also see now, especially in Wrocław, that the numbers are rising. So currently, the 85% of the footfall is very similar across all of our portfolio. The difference are few percent. The turnover figures are also the same across the portfolio. So we do not have any winners or losers. The situation is reflected across Poland equally.
Thank you, Michał. The second question, Jacek, I would ask you to take from Jonathan Dutoit. What is the strictest LTV covenant in our portfolio?
The strictest covenant is at the level of 65%.
Thank you. Next question I will happily take, also from Jonathan. Is there a target LTV that you would like to achieve through asset sales? The answer is that we have ambitious plans. We'd like to get possible as low as 40%. However, as I stated, we are prepared to consider asset recycling only if we get to the right pricing. So we'd rather take a little bit longer if need be than rush up without the real need. So this is a long-term target. We hope that it should be possible with the overall liquidity in the Polish market to realize in 18 months. But there is a bit of a caveat there that we'd rather make it in steps and take a bit longer if need be. But we have a plan to significantly go down with the ratio. Jacek, next one would be for you, if you may. More specific question from Jonathan. In admin expenses, there is a charge for external services. What does this relate to? To whom it is paid? In 2019, it was euro 8.4 million.
So basically, external services, these are the services related to the accounting service that we are fully outsourced to the third parties. These are basically legal expenses and audit expenses that we normally incur during the period. So these are mainly the major sources of the external services provided to EPP.
Thank you, Jacek. The next two questions are talking about the same thing, which is Towarowa 22. Question from Simon. What's the thinking on the timeline, given the liquidity position of EPP? And the second question comes from Andy. Summer, what is the acquisition? Sorry, that's not the one. What is the plan? Sorry, from Jonathan. What is the plan for Towarowa land? We are clearly aware of our liquidity position. We are considering our options. For Towarowa, it is too early to say, but one option that we would consider is also recycling of this asset if we can get the right value. It's too early to say today, but we're looking at the spectrum of possibilities in order to make the best possible decision for EPP. As in case of any other asset, this could only be an option to recycle if we can get the right value for it. But also with our joint venture partner Echo, we're working on the optimal development plan for the site that is being revised to take into consideration the changing market conditions in terms of demand and supply in various asset classes. Next question. Under what scenario do you think you would need to raise equity to de-gear faster? We can take it between me and Jacek. As stated in the note, at the moment we're not expecting and planning the equity raise. We don't believe it's necessary, especially given where the share price currently is. We believe EPP is having financially and fundamentally healthy business with a significant growth potential from where we are today. And therefore, this is not a strategic plan. As stated, we are confident with our senior debt providers, who are long-term players, that we can agree the extensions of the loans or find new banks to refinance if there would be better terms. So we believe we are in comfortable position in order to only consider equity raise when the market conditions for this equity raise will be attractive. We don't think they are at the moment. Last question on the list. Let me just refresh to make sure that this is it. There's new one that came. So the question from Andy as well: what is the acquisition and sellout strategy for the next 3-year midterm? I have talked a lot about the selling strategy. That is going to be our focus for the next 18 months. So except tranche 3 that we intend to complete, we're not thinking acquisitions at the moment, as you can imagine. We will revise our plans throughout the 2020. At the moment, new acquisitions are not really something we're thinking of. Last question on the list. Michał is best to answer that. When do you expect to get back to near pre-COVID-19 rental income levels? Would it be fair to say the portfolio could comfortably settle at circa 95% of pre-COVID levels by January 2021?
Well, as you have seen the numbers, which are growing both on turnovers and footfall, of course, we see the whole development of the COVID situation and the possibility of having a second lockdown is close to zero. We strongly believe that now this autumn and winter season will allow the tenants to regain their turnover positions of back from 2019. We strongly believe that their turnovers by end of the year, beginning of next year, will be at the level close to 100% and pre-2019. And like Tomek has mentioned, in our forecast of the rental incomes is that we start 2021 with our regular rents paid by the tenants, with some small exceptions for which extend, some of the rebates extend for January. So yes, the end of 2020 hopefully will be the end of all the commotions related to COVID, and 2021 will be back to normal business where we can start growing the potential of our shopping center, just like we've been presenting in January and February this year, where we had a both growth of footfall and turnovers. And again, the fundamentals are strong as we own 25 dominant shopping centers. They are fully leased. They have a strong, healthy rental covenants. We have both international and strong national tenant. They all maintain with us during the COVID time. So we have all the necessary fundamentals to further grow the business. And like I said, the numbers that we have seen can give us a strong prediction that by end of this year, beginning of next year, we should be back into the normal businesses, starting building the business back again.
Thank you, Michał. I can only add to that our strategy was either to provide bigger discounts if need be, fully eaten up in 2020, or smaller discounts but spreading a bit longer. Some of that then reached out to early months of 2021. So we do expect to come back to not only 95% of pre-COVID, but hopefully to pre-COVID levels, but a bit later in 2021. So 2021, as per our expectation, definitely is going to be way better than 2020. Maybe not exactly fully at the level of 2019, but our plan is to be back in the space as soon as possible. Okay, 2 final questions. I'm being cautious and aware of time. What CapEx do you intend to undertake during the next year? Michał, do you want to take it?
Yeah, we've looked at the CapEx spending this year. I think we made a great progress in terms of minimizing the CapEx and return getting also a good equivalent of the rental income. Our shopping centers do not require any material alterations, refurbishments. Back in the last 4 years, as some of you have seen, we have done fantastic changes to some of the food courts that we have, especially Pasaż Grunwaldzki went under, I think, a very important and very significant changes within the mall. The same thing happened in Galaxy with introducing the lighting, LED lighting system and with the whole refurbishment related to the extension of the shopping center. So we will be very now cautious looking at the CapEx, which will be only related to significant tenant improvement. Yet then also in this case, I think also tenants are aware of this. We will be very, and again, always as we were, cautious about spending. No other CapEx is forecast for improvements in the shopping center, alteration, infrastructure CapEx. These are very well managed assets and is such an age that still allow us to operate without significant or any bigger CapEx spendings.
Thank you, Michał. Last question relates to, this is a new one, but the first one then. When you say right price for asset sales, are you looking for a particular premium on book values? Well, the answer is yes, we'll analyze our portfolio. As I said, we'll only trade at the right price. In some cases, the right price might be the book value. In some other cases, there might be a possibility for a premium. We will be looking to identify only those assets that can really make a very strong case in that respect. Last question then, they keep coming up, which is good. Do you have any plans to list on a major European stock exchange or a Polish stock exchange to increase the profile of EPP in Poland or Europe? Between me and Jacek, but maybe I'll answer this briefly. We don't exclude this option. However, I would put it in relation to the question that was there on the capital raise. I strongly believe it is interconnected, so it makes sense, but in a mid to longer term, rather than immediately, for the very same similar fundamental reasons. But over time, Poland or maybe elsewhere in Europe could be the way to go. We're especially monitoring Polish market. The Polish government is clearly focused now on COVID, but they have started works on REIT legislation in Poland, and they have longer-term strategic plans of persuading Polish capital to be invested in Poland via the Warsaw-based stock exchange. There's a lot of capital there potentially to take over. There's very little dividend companies in Poland. So the answer is potentially yes, but we would be very careful and cautious in terms of when the right timing for this could be. Thank you very much. This was the last question on the list. Clearly via Kerwin, we're available to answer the questions later on if you have any more. Thank you very much for your time, and we look forward to continue to be with in touch with you. And we hope the presentation, the highlights of EPP business, and especially our commentary on EPP business going forward, and why we all believe it's in a healthy and growth perspective position, were well received and understood by you. Thank you very much, and we stay in touch.
Thank you.
Bye-bye.